And today is D, the letter D, and D is for depreciation. Depreciation is one of my favorite tools to help you save money on taxes because it essentially shields your cash flow from taxation, okay? When you write something off using depreciation. And those are your fixed assets, you know, your cars, your equipment, your buildings, your trucks, anything else that you buy that may actually help your business and help grow your business, but you are able to depreciate it is a real great tool for you, okay? Because it essentially lets you use pre-tax money to buy things instead of after-tax money. And pre-tax money is much cheaper than after-tax money. If you really think about it, after-tax money, you know, if you're a Schedule C, your marginal tax rate, which is sole proprietorship. Sorry, I just kind of rattle these things off, and sometimes I totally forget to just explain them. I apologize. It's part of the lingo of the business that I'm in. If you're a sole proprietorship and you're making $60,000 a year, your marginal tax rate, meaning the tax you're going to pay on every dollar above $60,000, is going to be over 40%. Okay, so to be able to buy something and write it off is a real valuable tool because it's 40% cheaper, okay, if you factor in the depreciation and taxation. The new tax law depreciation rules are really generous. If you buy a vehicle over 6,000 pounds, gross vehicle weight rating, pickup truck, SUV, a regular truck, you get to write that thing off 100% right away. So you could essentially get a significant discount by investing in new equipment that you can write off right away. Obviously computers, you know, all your other equipment, trailers, anything else that you might buy for your business that's considered equipment is also something you can fully write off. Buildings. You can actually, you know, most commercial buildings, you're looking at 29 years, residential buildings, 27.5-year write-off periods, which makes it feel like you can't take a lot of deductions for that every year, even though you get some, but not very much. Well, you can do a cost study on those buildings, which breaks the building down into the different parts and can let you write off part of that building as equipment, as improvements, as other things that will qualify for bonus depreciation. So when you buy a building, it could be really, really valuable to you because if you do a cost study on that building and break the building apart, you can get write-offs immediately. And it's a great new tool under the new tax law. And it's really a combination of the old tax law and the new tax law that really creates really phenomenal results for business owners. So D is for depreciation. You got to use it, you got to maximize it. One of the common mistakes I see with business owners that don't have a fully integrated set of books that tie to their bank accounts or credit cards is that people go out and buy things and they forget to tell their CPA or tax preparer that they bought a truck, that they bought an asset, that they bought something new, and as a result, it's never written off their taxes, and they're just overpaying on taxes. I mean, if you buy something that's $40,000 or $50,000 and you forget to write it off because you don't have a good set of books, you don't have clarity on your financial situation, then you are looking at, you know, a 40% penalty, okay? $16,000 in extra taxes, $20,000 in extra taxes. That's no good. Depreciation is really important. You got to make sure you use it. Peter Holtz, CPA. It's about really more money in your pocket when you use depreciation. Thanks.